Hi, welcome back to the podcast, Mark. How are you?
Good. How are you, Andrew?
I'm doing great, and it's great to see you again. We're going to get into the recent headlines in a moment, but I wanted to first just kind of go back to 2025. Even though it might feel like a decade ago, it was a pivotal year for Canada. We had the federal election, we had Liberation Day, we had plenty of other noise outside of those. But in your view, what did you see as the real market movers over the year, and how did you navigate through those themes?
Yeah, it was definitely categorized by a number of big shifts. Not only did you have the U.S. Election in late 2024 and new administration come into power in 2025, Canada also had its own federal election, and that coincided, soon after Liberation Day. And obviously, there's a really big shift in the Canadian markets. A lot of fear, risk off in the markets post the potential economic and market impacts of tariffs and wide-ranging tariffs across a number of countries globally. As we saw news develop throughout the year, it was became more clear that was more of a starting point in negotiations. And a lot of the big major areas of the Canadian economy, such as energy, were exempt from a lot of the tariffs under CUSMA. And so that really big immediate risk, definitely, while the market priced that in very quickly, incrementally, as more data came out, we saw throughout the year that that risk was being pushed out further and further. And then probably more importantly, longer term from our perspective, just a big ideological shift in Canada that's taken place with new federal government, a lot more pro-growth focused, thinking about Canada as an energy superpower, building Canada across sectors across the country, and promoting economic growth relative to maybe picking winners or losers or more restrictive regulatory stance. And that's a pretty big shift from the direction that things have been going for the last 10 to 15 years. And ultimately, big portions of the Canadian market benefited from that. And so not only did we see recovery in energy and commodity stocks through 2025, banks were very big drivers for the market. So financials index was up roughly 30% in Canada. And so all the Canadian banks, particularly TD, had a very good year. Really, why was that? A few big factors from our perspective. The risk off large credit risk that tariffs could have resulted in, that largely didn't come through. And so credit conditions remained relatively healthy for the Canadian banks. They also have very big wealth and capital markets businesses that performed very well. And on top of that, their funding costs have improved. And so as interest rates have come down, and so we're seeing some positive margins at the banks. And lastly, from a regulatory perspective, just in line with the shift, I think, in the federal government in Canada, potentially a shift to a more pro-growth focused regulator that's focused on keeping the Canadian banking industry competitive globally. And that's boded very well for the banks in Canada. Outside of that, there's certain large companies in technology sector that had very good years. So Shopify, a company that we've owned within the Canadian equity strategy for a number of years, and that business continues to do very well. Some of the AI tailwinds are benefiting companies like that, while other companies, the market saw more risk and maybe some of the legacy software acquirers in Canada. So with that, we added to banks throughout the year. We've added gold exposure given the favorable unit economics for the producers there. I think valuations are relatively reasonable. And in the world that we're in, we see a number of just tailwinds to gold, whether it be the geopolitical events, some of the de-dollarization theme that's in the market with fiscal policy just becoming very untethered from tax receipts across a number of countries, and there's limited ability that for governments to cut spending, and so odds are that we'll likely see more of the same from our perspectives. Lastly, I'd say the other thing that we always do as we're bottom up focused is we continue to seek out idiosyncratic opportunities, whether that's CAE, a defense business, and a commercial airline training business that's got new management from Northrop Grumman, number of defense tailwinds for Canadian companies. And I think there's an opportunity there to improve capital allocation with a new board chair as well. And offset that with areas in the portfolio that we thought were maybe expensive and we thought we could recycle the capital, or areas where just fundamentals weren't as strong. So rails would be one example of that.
Well, you covered a lot of ground there. You hit on a number of themes that I think are going to, I'd like to explore a little bit more. Energy, commodities, geopolitics, you touched on. Let's bring it to the present day. And I think we're all still digesting the news from the first week of January regarding the U.S. intervention in Venezuela. And the market reaction, at least as it pertains to Canadian stocks, it really caught my eye because I saw Suncor and Canadian Natural both dropped, but only Suncor has really recovered. And I'm curious to hear, is the market trying to tell us something bigger here? Specifically, does this mean that being fully integrated, so owning the refinery, for example, is that the only reliable safety net for an oil company when we face this level of geopolitical instability?
Yeah, it's definitely a scenario that's been top of mind over the last year here, but particularly in recent months, as we've seen commentary out of the U.S. government regarding Venezuela, and we thought the odds that there was some political change there increasing, particularly just given comments from the Trump administration, and recognize that Venezuela is historically been a larger producer. At times, it's produced 2 to 3 million barrels a day of crude, and it does compete with the crude oil in Western Canada as it's more of a heavy grade of crude. And so in December, we'd actually taken down some of our C&Q exposure in the portfolio or in the strategy and maintained our Suncor exposure. Main reason there being, as you mentioned, Suncor is a lot less exposed to differentials between Western Canada Select and U.S. Crude oil pricing, just given the refinery business that they have. And so now C&Q themselves, they do upgrade a lot of their production. And so it does receive higher pricing than production from some of the competitors in Canada that is not fully upgraded. And so that does help Canadian Natural. But on a relative basis, you're right. Suncor is a lot less exposed to the differential. And so, while immediately in the market, we didn't see much of an impact on crude oil futures, they've really across the curve only moved a couple of dollars in the last 6 months. However, that prospect or the idea that Venezuela could bring on another 1 or 1.5 million barrels over the long term does exist. And now I think the question is, will they be able to create the necessary conditions so that private companies say, we think going in and developing those barrels are more attractive than doing it in Guyana or the Permian Basin or in Canada and elsewhere in the world. So very sharp, immediate reaction, but think it's really more of a longer-term risk that we need to be mindful of. One of the other offsets, though, that is positive for the Canadian producers is that we do have TMX pipeline moving oil to the West Coast. And so there's an argument that those barrels going to Asia those can really help essentially set pricing for the entire basin. And so while we might see wider differentials if Venezuela production ramps up over the next 5+ years, uh, probably unlikely that it goes to levels that we saw in 2018 or so, where you had very, very wide differentials relative to WTI. So, as we talked to a number of oil companies in December, and a number of them noted that some of their highest net backing barrels are actually sold off of the West Coast, and that's even with a fairly high pipeline tariff on the spot obligations on TMX. So overall, shifted some of the exposure, maintained our Suncor exposure, brought it down in CNQ just to manage that risk. Saw that risk get realized, and so now on a go-forward basis, I think everyone in the basin is glad probably that you do have that optionality to sell barrels West Coast, and it probably increases the urgency from the powers that be to look at further diversifying the offtake markets for Canadian energy, given that risk. So, yeah, fairly big outside of just the oil market impact in Canada. Fairly big, just change, I think, for the world. So, number of other broader implications as well.
Speaking of change, I think the situation in Venezuela is a good bridge to discuss a structural change that seems to be underway. And Venezuela may just be a symptom of a larger trend. And if you read the recent update to the U.S. national security strategy, and I think we can try to link that in the show notes for everyone, it signals a move away from alliance building, and it's moving much more toward this sort of concept of transactional spheres of influence. If that's our new reality, Mark, where Canada is treated less as a partner and more as a piece on the board, how does that change your risk assessment and valuation work? Are you assigning a higher risk premium to Canadian businesses today, perhaps exporters in particular, than you were a year ago?
Yeah, you point out a topic that's been a big topic of discussion internally on the research team at Mawer, where the world has clearly changed. We're in a more of a new world order. Following League of Nations post World War I, that didn't work out, converted and was followed by United Nations, and really a period of globalization, economic cooperation, and public diplomacy, really the great powers using more soft power or even, cultural attraction. And that has clearly shifted to a more dominant, assertive power. One observation from Jim Hall really on our team was really just the evolution into the world more of mercantilism, where you have dominant powers, almost a colony type system, and spheres of influence where certain countries, the great powers, really place more emphasis on exports, driving economic activity, being interventionist, having government drive economic policy, and using those other colonies, if you will, to really provide secure sources for things like natural resources, energy, minerals, things that the major powers need, and trying to secure those supply lines. And so that's just the new world that we're living in. That dovetails into some of why we've just added new areas of portfolio to the portfolio, like gold, because we think that exposure makes a lot more sense now, especially in this new world. But if we look at just how the markets are reacting to that, we're still seeing very tight credit spreads. Currencies are acting stable, and Canada's playing along. So I think there's recognition, it seems, from different government policies that we're seeing, that Canada is likely best suited to get aligned with these economic priorities. And the good news for Canada and the Canadian markets is that Canada is very well set up with comparative advantage in natural resources, being close to the US, having very similar culture and values for the most part. And so think overall, from a portfolio perspective, one thing we don't want to do is make a very large bet in one way or another on certain economic policy outcomes and be diversified from that perspective, as the policies can change very quickly. So if we anchor ourselves to one outcome, I think that's very that's a big risk for any portfolio to take. And so that's one thing that we're looking at and trying to be mindful of. Another thing we've talked about in the past, Andrew, is just trying to be on the right side of City Hall. So if we have themes that we think are playing out, whether it's energy, infrastructure, electric grid infrastructure tailwinds, and that also is aligned with economic policy of governments across North America, that's probably a better place to be than areas where you may be more of a target. And so that's one way we're thinking about just headwinds and tailwinds, and we'll go through the portfolio really on a bottom-up basis to determine whether we're positioned well, or if there's other things outside of the portfolio that we should take a closer look at to include.
Just in the last couple of minutes that I have you, a final question, and it's really kind of stepping back a bit, because if we are in this environment where the rules of the game are being rewritten, whether it was NAFTA or the entire post-World War II global order, in your view, what's the biggest trap or maybe mistake that long-term investors should be trying to avoid? And I think you touched on one just in the immediate term in terms of reactionism.
Yeah, I think big shifts and tying the portfolio and clients' capital to a very specific outcome, whether that would be going all in on commodities, going very risk off, or very risk on into some of the higher growth, riskier areas. That remains top of mind for us, as well as just shifting with the odds. And we've talked about this before, but you can think about various scenarios and global events that have happened in the world, and we're watching those closely and trying to shift with them. So shifted somewhat before this Venezuela risk has been realized, because oftentimes there are they don't totally come out of the blue. They are signaled by powers that be in advance. And so trying to shift as we see those odds shift. And it can be very incremental in the portfolio, small 5-10 basis point moves often. But you can think of, even a few years ago when Russia-Ukraine happened, there was many maybe living even in Ukraine that thought probably for a very long time that's not going to happen. That's not going to happen. Okay, this is as bad as it's going to get. And then it starts to get a little bit more serious. And well, this is as bad as it's going to get. And all of a sudden you're in a multi-year war, thinking, how did we get here? So that's what we're trying to avoid. And that's, I think, why we continue to shift. And you can look at some of the top companies in Canada right now. If we look back 20, 30 years ago, there'd be different companies in that mix of the top 10 companies. And so that's why we think it's reasonable and prudent to just shift with the odds as the world is constantly changing. And so that's what we will continue to do.
All right. Well, we covered a lot of ground here. I always appreciate your commentary and insights, Mark, and thanks for joining us.
Thanks, Andrew.